Exercise 1.3 required. 1.3.1. Match the concepts in column A with the descriptions in column B. Write only the letter A to E next to the question number I to V on the answer sheet. Okay, so column A, I, memorandum of incorporation. That would be B, a document compiled before a company is registered that sets out the rights, responsibilities, and duties of the directors, shareholders, and other stakeholders relating to the company. So let's enter the answer of B. Then II, issued share capital, that would be D, the number of authorized shares that are sold. So let's enter the answer D. III, articles of association would be E. This document sets out the goals and nature of the business. So let's write down E. Then IV, matching principle or accrual accounting, would be A. Income generated within an accounting period must correspond with expenses during the same period. And then V, authorized share capital would be C, the total number of shares that a company may issue. (1.3.2) Analyze the following transactions and show the effect on the accounting equation. Show an increase with a plus and a decrease with a negative in front of the amount. Answer each question independently from the others. Transactions. Number A. 21,000 Rand is paid via EFT to SARS as a second provisional tax payment. Okay, so the account to be debited will be SARS income tax. And the account to be credited will be bank. We will decrease our assets with 21,000 Rand. And we will decrease the liabilities with 21,000 Rand. Number B, buy back 70,000 shares from the solvent estate of a shareholder. The repurchase price is 56 cents above the average share price of R2.50. Now remember, we will have two entries. One goes to the ordinary share capital account, which is your average share price per share, and then the difference goes to the retained income account. So firstly, we are going to debit the ordinary share capital. and then we are going to credit bank. We're going to decrease the assets with 175,000 Rand, and that would be the 70,000 times 2 Rand 50. So let's do that. So we're going to say minus 75,000 in our assets, and then minus 175,000 in our owner's equity. No effects in liability. Then the difference goes to the retained income account. So we are going to debit retained income. And credit bank. And that amount would be 39,200. So that would be the 56 cents times 70,000. Okay, so we can have minus 39,200 in our assets. As well as minus 39,200 in owner's equity. Then number C, a final dividend of 20 cents per share is declared on the 230,000 issued shares. So we are going to debit ordinary share dividends. And we are going to credit shareholders for dividends. And it's going to be minus 46,000 in equity and plus 46,000 in your liabilities. How did I get the 46,000? It's the 230,000 issued shares times 20 cents. So in your owner's equity, negative 46,000. And in liabilities, positive 46,000. And then number D, directors' fees of 2 directors who owe each 40,000 Rand is still outstanding at year end. So we are going to debit directors' fees. And we are going to credit accrued expenses because the amount is still owing. And it's going to decrease our equity and increase our liability. 40,000 times 2 gives me 80,000. So we're going to have negative 80,000 in owner's equity and positive 80,000 in liabilities. One point 3.3. Refer to the given ledger accounts and additional information and complete all the missing information in the accounts. So the first account we need to complete is the ordinary share capital account. If we go to the additional information, number 1, ordinary share capital. The company has authorized share capital of 1.2 million shares. 70% of the authorized shares are already in issue on 1 March 2024. So our issued share capital would be 1.2 million shares times 70% to give us 840,000 shares. A further 160,000 shares are issued on 30 May 2024 at a price of R8.80 per share. So let's go and enter their transaction. So we go to the ordinary share capital. On the credit side, May 31 bank in our cash receipts journal. We will then work out the amount of shares that was issued. So it's going to be the 160,000 shares at R8.80. And that gives you 1,408,000. So let's enter that. 1,408,000 rand. Then on 31 January 2025, 90,000 ordinary shares are bought back from an unsatisfied shareholder. The company paid 70 cents above the average share price. Okay, so we know that the share price is R8.80. So if it's 70 cents above the share price, we then purchased or repurchased that shares for R8.30. R8.80 minus 70 cents gives me R8.30. So on the debit side, 2025 January 31 bank, in our cash payments journal, we are going to take 90,000 shares and times it by R8.30, which is the average share price at that stage, and that gives us 747,000 rand. So we'll have a main total of, if we add those two amounts together, we get an answer of 8,300,000. And that obviously equals the same as your debit total, 8,300,000. So our balance carried over on February 28th would be 7,553,000. The retained earnings accounts we can only complete once we've completed the appropriation account because it will be our balancing figure. Ordinary share dividends account. On 31 August, 43 cents per share is declared. So we need to pay an interim dividend of 43 cents per share. So we need to calculate how many ordinary shares we have on that date. So we started with the 840,000 ordinary shares at the beginning of our financial year. Then we issued a further 160,000 shares on 30 May 2024. So now we have a total amount of 1 million ordinary shares in issue. And then we times that by 43 cents to give us 430,000 Rand. So on the debit side of ordinary share dividends, we are going to write shareholders for dividends. That will go to the general journal. And the amount will be 430,000. On 2025, February 28, we have shareholders for dividends, 391,300. So there we need to write shareholders for dividends. General journal. If we add these two amounts together, we get a total of 821,300. 821,300. That obviously needs to be the same as the credit side. $821,300. So on the credit side, we will close this amount off to the appropriation account. Also general journal. And the amount 821,300. So now we go to the appropriation account. At ordinary share dividends, we will recall that amount of 821,300. Our income tax amounts to 30% of the net profit. So to calculate the net profit, we are going to take the 483,600, which is our income tax, times 100 and divide by 30 to give our net income. And then we get an answer of 1,612,000. So that would be our main totals on the debit side. As well as the credit side. So our balancing figure would be retained income. On the debit side, we write retained income. Also the general journal. $1,612,000 minus your income tax minus your ordinary share dividends gives you $307,100. And that is the amount that you take to retained income. So go to retained earnings or retained income account. On the credit side, February 28th appropriation account, general journal. We then record the amount of $307,100. And then that will give us our main totals of $700,000. Okay, so the 700,000 was calculated by taking these two amounts, your opening balance brought forward and the amount that goes to your appropriation account. You add them together and then you get 700,000. So our balance carry over would be on the debit side. $700,000 minus 63,000 gives us 637,000. $1.3.4. The information provided is an extract from the records of Always Limited for the financial year ending 28 February 2025. Required. Use the information and complete the open accounts in the General Ledger of Always Limited and close it properly on 28 February 2025. Information. Number 1. Ordinary shares. The company has authorized share capital of 4 million shares. On 1 March 2024, 50% of the authorized shares had already been issued at an issue price of 7,600,000. On 30 April 2024, 500,000 shares are bought back at R4.10 per share. On 1 November 2024, 200,000 new shares are issued. On 28 February 2025, the balance of the ordinary share capital account shows the value of issued shares at R6,800,000. Number 2, income tax and net profit. On 1 March 2024, the SARS income tax account shows that 18,000 Rand is still due to SARS relating to income tax of the previous financial year. On 20 March 2024, the outstanding amount is paid via EFT to SARS. On 31 August 2024, the provisional tax liability for the first 6 months is estimated at 250,000 Rand. An EFT for the amount is made to SARS. The total provisional income tax liability for the year is estimated at 725,000 Rand. An EFT for the second provisional tax payment for the year is made to SARS on 15 February 2025. Company tax is calculated at 30% of the net profit. The net profit amounts to 2,500,000 Rand. Ordinary share capital account. We will start on the credit side with our opening balance. So 2024 March the 1st. we will write balance brought forward. And our balance brought forward is 7,600,000. Then on the 30th of April, we bought back 500,000 shares at R4.10 per share. But remember, the amount that we record in our ordinary share capital is the average price per share. To calculate the average price per share, we have to work out the ordinary shares in issue at that date, and they say 50% of the authorized shares had already been issued. So 50% of 4 million shares will be 2 million shares. So 7,600,000 Rand divided by 2 million shares gives me R3.80 as my average share price. So we will say 500,000 times R3.80. So on the debit side, 2024 April, it was on the 30th of April. We will write bank because we're making a payment. Goes to our cash payments journal. And 500,000 times R3.80 gives me 1.9 million Rand. Our balance carried over, as stated in the question, is 6,800,000. So we will have a balance carried over. $6.8 million. To give us a main total of 8.7 million. The debit and the credit side must always balance. So on the credit side, November the 30th, we issued new shares, but they didn't state at what value. They just said 200,000 new shares were issued, so that will be our balancing figure. November. Bank. We will go to the cash receipts channel, so we are receiving money. And our balancing figure will be 1.1 million. $8.7 million minus 7.6 million gives me 1.1 million. Then also on the credit side, March the 1st, balance brought forward. $6.8 million. So as income tax, on the credit side, we will have an opening balance of 18,000. So 2024, March the 1st. We will have a balance brought forward. $18,000. This balance owing was paid to SARS on 20 March 2024. So on the debit side, 2024 March. The 20th. Bank CPJ, because we're making a payment to SARS. $18,000. So now the credit and the debit side is square. Then on August the 31st, we made a provisional tax payment of 250,000 Rand. So August 31. We will write bank. Also the cash payments journal. $250,000. Then on 2025, February the 15th, the total provisional income tax liability for the year is estimated at 725,000. So we need to then still make a provisional payment of 475,000 Rand. To calculate that amount, it was the 725,000 minus the 250 that we've already paid to give us 475,000. So 2025, February the 15th. Bank. cash payments journal. £475,000. Then the company tax is calculated at 30% of the net profit. The net profit amounts to 2.5 million rand. So 2.5 million rand times 30% gives you a total of 750,000 rand that is owing to SARS as income tax for the year. So on the credit side, 2025, February the 28th. We will write income tax. General journal. $750,000. So that means we owe SARS 25,000. So we'll have on the 28th a balance carried over. $25,000. To give a main total of 750,000. And that will be the same as the credit side main total. So on the credit side, March the 1st, we will have a balance brought forward of 25,000.